Initiating coverage on CyberVantage with an outperform rating and a 12-month price target of $145, implying a 24% upside from current levels. CyberVantage represents a paradigm shift in proactive vulnerability management, leveraging AI-driven predictive modeling to identify zero-day exposures before exploitation. As enterprise attack surfaces expand through cloud migration and IoT proliferation, traditional reactive endpoint security is proving insufficient. Our thesis centers on CyberVantage's proprietary threat intelligence graph, which has demonstrated a 40% reduction in breach probability for enterprise clients. We model a conservative 28% top-line CAGR through fiscal year 27, driven by robust net retention rates exceeding 120% and expanding operating margins as R&D leverage scales. The macro environment for cybersecurity spending remains highly resilient, functioning as a non-discretionary budgetary item despite broader macroeconomic headwinds. We estimate the total addressable market for proactive vulnerability management and attack surface reduction at $32 billion currently, expanding to $55 billion by 2028. This implies a market CAGR of 14.5%. The catalyst is the regulatory environment, specifically the SEC's new cyber disclosure rules, forcing C-suites to transition from legacy compliance checklists to continuous threat exposure management. Currently, penetration in the mid-market remains under 15%, presenting a massive white space. CyberVantage is uniquely positioned to capture market share from legacy vendors due to its agentless scanning architecture, which reduces deployment friction by 60%. Dissecting the platform's architecture reveals a substantial economic moat built on data gravity. Unlike traditional scanners that rely on common vulnerabilities and exposures databases, CyberVantage utilizes a proprietary predictive threat graph. This engine ingests over 50 petabytes of telemetry daily, applying machine learning algorithms to map hidden attack vectors across cloud, on-premises, and hybrid environments. The critical differentiator is context. While legacy peers generate alert fatigue with thousands of low-priority flags, CyberVantage prioritizes the top 1% of exploitable vulnerabilities that carry actual business risk. This prioritization engine translates to a demonstrated return on investment of 300% over a 3-year period for enterprise clients, driving an exceptional gross retention rate of 98%. Analyzing the underlying unit economics reveals a highly efficient go-to-market motion. Customer acquisition cost has remained relatively flat over the trailing 12 months, while the lifetime value of the customer has expanded, resulting in an LTV to CAC ratio of 4.8. This is best in class for enterprise software. The primary growth engine is the land and expand model. Initial land deals typically encompass core vulnerability management, but we are seeing rapid cross-sell into cloud security posture management and identity threat detection. This dynamic is reflected in the net revenue retention rate, which has accelerated to 124% in the most recent quarter. As customers adopt 3 or more modules, churn drops to near zero, heavily insulating future cash flows. Shifting to the income statement, we model a robust top-line trajectory, coupled with meaningful operating leverage. We project total annual recurring revenue to scale from $750 million in fiscal 23 to $1.58 billion by fiscal 26. This represents a 28% compound annual growth rate. More importantly, we are observing an inflection point in profitability. Non-GAAP operating margins, which stood at -4% last year, are projected to cross into positive territory at 6% this year, scaling to 18% by fiscal 26. This margin expansion is driven by a natural decrease in sales and marketing intensity as a percentage of revenue, moving from 45% down to 32% as the organic channel matures. The true indicator of this platform's financial health is its cash generation profile. The company operates with a negative working capital model, collecting subscription fees up front. We forecast free cash flow margins to expand from 8% to 22% over our 3-year forecast period. This will generate cumulative free cash flow in excess of $800 million by the end of fiscal 26. Turning to the balance sheet, the company is exceptionally capitalized, holding $1.2 billion in cash and short-term investments with zero convertible debt. This fortress balance sheet provides significant optionality for tuck-in acquisitions to accelerate module development or opportunistic share repurchases, further supporting the downside floor on the equity valuation. Valuing high-growth cybersecurity assets requires normalizing for growth and margin profiles. CyberVantage currently trades at an enterprise value to next 12 months revenue multiple of 8.5 times. While a premium to the broader software index, it trades at a 15% discount to its direct peer group of next-generation security platforms, which average 10 times EV to sales. When adjusting for growth using a growth-adjusted EV to sales framework, the stock looks particularly compelling. Moving down the P&L, as the company scales into its operating model, we value the firm based on a target enterprise value to free cash flow multiple of 35 times our fiscal 26 estimates. Discounted back at our WACC of 9.5%, this yields our $145 price target. From a technical perspective, the stock has recently formed a classic cup and handle consolidation pattern on the weekly chart, supported by institutional accumulation. We observe a golden cross, where the 50-day moving average has cleanly breached the 200-day moving average on above-average volume. Relative strength index stands at 62, indicating bullish momentum without being overbought. Key resistance is observed at the $125 level, representing the previous 52-week high. A high-volume breakout above this resistance level would confirm the structural uptrend and likely trigger systematic momentum buying, opening the door for a rapid test of our $145 fundamental price target. Downside support is firmly established at the $98 volume point of control. A rigorous analysis mandates examining the bear case. Our primary concern is vendor consolidation. As macro budgets tighten, chief information security officers are attempting to reduce the number of discrete point solutions in favor of platform ecosystems offered by mega-cap tech players like Microsoft. If CyberVantage fails to maintain its technological edge, it risks commoditization. In our bear case scenario, we model a severe deceleration in new customer acquisition, driving the revenue growth rate down to 15% and contracting net retention to 105%. Conversely, our bull case relies on accelerated adoption of the company's autonomous remediation features, effectively removing humans from the patching loop. If this module gains traction, average revenue per user could expand materially. In this scenario, we model revenue growth accelerating to 35%, with operating margins expanding to 22% by fiscal 26. Assigning a premium 12 times EV to sales multiple yields a bull case price target of $185. In conclusion, CyberVantage offers a highly asymmetric risk-reward profile. The combination of best-in-class unit economics, accelerating free cash flow, and a compelling valuation relative to peers makes it a top pick in the software infrastructure sector. We reiterate our outperform rating for institutional portfolios.